April was a big month for the bulls, but last Friday, May 1st, was another month. And as we have often seen in previous bear market bounces, the gains we had for April were fantastic, with stocks having their best 1 month advance since 1974. Unfortunately, in many cases, the majority of those big 1 month gains are followed by negative returns. And as they say, timing is everything. So with Friday's poor performance, is it time to sell in May and go away? Let's take a look. Regardless of the information and data, I do not advocate selling in May and going away. Hopefully, our subscribers and viewers understand that one needs a good plan and to stick with it. That's a better idea, and that's exactly what I'm doing. So, although April was great, March was not so good. Even with April's rebound, if we go back 6 months, we don't have much to show for it. Have you heard about the Halloween indicator? And the other saying that you should sell in May and go away? Both refer to the seasonal patterns that show historical trends. The 6 month period that follows Halloween tends to be good, while the summer periods that follow May tends to underperform. Another question to ask is, are the summer months following losing winter months good for stocks? Going back to the great financial crisis, that was the case. From Halloween of 2008 through May Day of 2009, the Dow fell more than 12%. However, over the next 6 months, from May of 2009 to Halloween of 2009, the Dow gained nearly 19%. Could we be so lucky for this to happen again? Well, unfortunately, that impressive turnaround in 2009 looks to be the exception rather than the rule. That's what Mark Hulbert found when he analyzed all winter periods and summer periods in the stock market since the Dow was created back in 1896. He found that the Dow lost an average of 1.6% in summers that followed winters in which the stock market fell. This was in contrast to an average summer gain of 1.8%. But what happens in a presidential election year? Well, in election years, the odds do improve for the stock market, but not by much. Since 1896, the Dow in the summer months of presidential election years has produced an average gain of just over 4%. That's good news. The bad news is that in presidential election years, the Dow declined in summers that followed losing winters, posting an average loss of negative 0.6%. One thing to keep in mind is that the statistical significance of this information is weak. And here's another chart to give us more perspective. And while not every summer period is negative, the long-term history of investing during the summer months is not stellar. Given what I've talked about for the past week or more, specifically that the VIX is showing signs that we may have some volatility, being cautious going forward is a good idea. Now, looking at this chart here, the blue shaded area represents the seasonally strong period from November to April, and the lower flat portion of the chart toward the bottom, that is green, represents the seasonally weak period from May to October. And with the current state of the economy, earnings risks, and a need to realistically reevaluate the level of the stock market, the odds of a weak summer period are rising. I hope you all are prepared. If not, we'll be here. So for today, that's ChewDog Charts. Thank you.